Most beginner traders jump straight into trading futures without even understanding what they are. This video is your crash course on the basics everyone skips. This is the stuff that is going to help you understand futures on a deeper level to jumpstart your learning so that you can become a profitable trader faster. The idea of trading futures, speculating on the price of things, has a very long history, going back to ancient Greece. However, futures trading was first officially sanctioned in 1730 in Osaka, Japan, where they traded rice futures on the Dojima rice market. At the time, samurais were paid in rice and rice farmers paid their taxes in rice. So rice was seen by some as kind of like a form of currency, and it became important for some people to be able to hedge against falling rice prices. In the U.S., futures trading started in 1848 with the Chicago Board of Trade, where they began by trading corn futures. Farmers wanted to lock in a price for their crop in advance of delivery, and this helped buyers budget in advance as well. The Chicago Board of Trade later became the CME, which is where we currently trade futures. And then other assets besides just agricultural commodities were added to the exchange. In 1971, the foreign exchange future was added, which is called Forex, and many other assets can now be traded as futures. Things like interest rates, energy, metal, indexes, but not onions. We are banned from ever trading onions. So why do futures exist? Futures help companies leverage risk. For example, airlines buy their oil in futures so that they can lock in a known price. Imagine if the airline couldn't do this. They would sell you a ticket for $200 because that seemed profitable at the time. But then when the flight time gets here and the oil prices have skyrocketed, now your $200 ticket is no longer profitable for the airline. By purchasing their oil as a futures contract, they're afforded a more stable operating budget. Mutual funds also use futures. They use it to hedge their portfolio against potential losses. For example, if they own a large amount of S&P 500 stock, but they see the market might be going down, they can sell ES futures to make up for the loss that they believe they will take on the stock. Futures also allow for speculation about where traders think the asset value is going. Traders can buy assets when they are low and sell them when they are high. So what exactly is a future? A future is a contract to take delivery of an asset. The delivery date is set, the quantity is set. The only variable is the price, which goes up and down all day long with each buy and sell. Now, remember that delivery date? A futures contract has an expiration date that will vary by asset. For indexes, the lifespan is usually quarterly. You will want to either close your position before the contract expires or roll over the position to a new quarter's contract. The symbol will tell you the delivery date or the expiration date of the asset. For example, ESF9 is ES with an expiration date of January 2019. For most indexes, they expire on the third Friday of the month at 9:30 Eastern. Always check the volume of an asset you are trading to make sure that you're trading the correct contract. So what is volume? Trading volume is the number of shares or contracts traded for a security over a specific period of time. When volume is high, there's usually more movement in price. Orders are filled fast and there are fewer gaps in the price. Volume is usually highest at the open and close of the day, and volume will vary by asset and by time. Now that we've covered the delivery date and with that volume, let's look at quantity. Each asset has a unit or quantity. A tick is the smallest unit a futures price can move. For example, with ES, one tick is equal to 1/4 of an index point, and one index point is equal to $50, so one tick is equal to $12.50. With NQ, one tick is equal to 1/4 of an index point, and one index point is equal to $20, so one tick is equal to $5. Now that we know what a future is, let's look at a trade example. So imagine that this is the futures contract that we are trading on. It's for corn, we have a quantity, we have a delivery date, and we have a current price as it is right now. So let's say that I think that this is a good price for this corn and I want to buy this contract. So I agree to buy at this price because I believe that the price is going to go up. So now imagine that time has passed and the price has gone up to 150. So now I think this is a good place for me to take profits. So I sell that contract. I sell that contract to someone else who believes that this is a good price to buy corn at. And whenever I sell it, there's a difference between the sell price and the buy price of $50. And that $50 is added into my account. Now on the other side, imagine that I think corn is going to go down in price. So I agree to sell corn at $100, But the problem is that I am not a farmer. I do not have corn, and I don't have 5 bushels of corn just like sitting around. So how do I actually sell it without having any? What happens is that I am borrowing a contract from my broker to sell. So whenever I press sell, I'm actually borrowing at that point. So I am selling it at $100. And then as time goes on, the price goes down to, let's say, $50. And I think, hey, that's a good price. I think that's a good place to take profit at. So at that point, I'm going to flatten or close out my trade. But what is actually happening behind the scenes is that I am actually buying a contract at the $50 price, and that contract is fulfilling the borrowed contract that I borrowed from my broker. And then there is a difference of $50 from the buy price and the sell price, and that difference gets added into my account. But what happens if I'm wrong? What if I think that the price is going to go down, but it actually goes up to $150? And then at some point I decide this is too much, I need to cut my losses. So I close out my trade, and at that point I have to buy a contract from someone else so that I can replace that borrowed contract to my broker. So I buy at $150, and now there's a difference of $50, but instead they have to remove that $50 from my account in order to cover the buy. And what happens if I'm really, really wrong? What happens if instead of just going up to $150, the price goes up to $1,500? If at any point the price disparity gets so high that the money in my account cannot cover the difference, my broker can close out all my open positions at whatever price they're at and use the money in my account to buy back my borrowed contracts. There's also this thing about margins, which is basically like a buffer in your account, but that's for another video. Futures have a higher risk than just about any other investment vehicle because you could, in theory, lose an infinite amount of money on futures, or more precisely, you can lose as much money as you put into your broker account. And when this happens, we call it a blown account. Because of this increased risk management is critical for futures trading. Now that you know exactly what a future is, you are ready for the next step in your trading.